Thanks very much, Nick. We appreciate your insights and we'll see you again just now for the panel discussion. Our next speaker is Philip Liebenberg from ABAX Investments. Phil is the lead portfolio manager on the Nedgroup Investments Flexible Income Fund. The fund aims to outperform money market instruments using a diverse mix of fixed income assets, both locally and offshore, while placing a significant emphasis on capital preservation. Over to you, Phil.
Thank you for the introduction, Anil, and welcome to an overview of the Nedgroup Flexible Income Fund for the third quarter of 2024. As you can see there, the title of our presentation today is Time for Easing, and it's been an amazing quarter, as you can see, from performances across the board, where central banks started easing globally, and I think most of it started towards the end of the second quarter. But today we'll go into some of the detail, what we've seen in the markets, and some of the views that we see at the Nedgroup Flexible Income Fund. If you look at the quarter, fantastic performance, but let's just focus, as you can see there on your screen, you can see the annual performance gross of fees of 13% for the Flexible Income Fund. It's been an amazing year for income assets across the board. And then if you look towards, for the quarter, you can see there a nice nearly 4% return for the fund. Again, if we just look at over the year, what's been the big contributors to that performance? That would be floating rate notes at about 3.7% and nominal bonds, over 4% on the fund. I think the other message which we want to give clients here is that obviously we look at, diversification, and we had contributions across the board, including inflation-linked bonds, and then nominal or SA listed property, which you obviously had a fantastic quarter and year. So overall, quite good performance, but I think the star of the quarter and the last probably 6 months have been local assets and specifically SA nominal bonds. So what we're going to do now is just a quick reminder of what we do. The way we look at the fund, we've got a universe of income-producing asset classes that we evaluate on an ongoing basis, and we try and determine which of these asset classes are income asset classes are expensive and which ones are on the cheaper side. Why this is important this quarter is obviously we've had especially nominal bonds and property doing exceptionally well. So if you've got a fund that only focuses on bonds, you could argue that some of these bonds are looking to become fairly and even fully valued. So it's important to have the ability then to look at other income asset classes where you might see better relative value. So I think diversification across these income asset classes is quite important. And having the ability to look locally in Rand, but also look offshore where you can have some range of diversification. Now, if we look at our market views, I think the market views are quite interesting in this quarter. What has been absolutely fascinating is the performance we've seen from some of the asset classes. As you can see there on equities, as you know, the MSCI World, over 6%, emerging markets about 8-9%. The All-Share Index gave you nearly 16% in US dollars. If we move on the right-hand side to more the, fixed income indices, fairly decent returns. But what is absolutely amazing, as you can see, the All Bond Index gave you nearly 17% in dollars. So if you focus on that, you don't need to be a rocket scientist to figure out that SA Inc. on the equity side and the fixed income side had an absolutely fantastic quarter. And our local asset classes, re-rated from fairly cheap levels. Now, what was the start of this? I think, as mentioned, we had the start of the global rate cycle, and especially the US had a large 50 basis point cut. I think that if you look at the economy, where the economy is now a lot better in balance, if you look at employment still doing well, obviously they want to bring down inflation with higher rates and tighter monetary policy. But that whole employment and inflation equation is a lot better in balance, and the Fed has admitted that now the focus has shifted a little bit to employment and make sure that they can keep to their dual mandate. And then obviously towards the end of the quarter, we know the Chinese economy is fairly soft, but they had quite big stimulus coming out of China. where the People's Bank of China announced a range of measures to get the economy going, but also to help property owners and the property market, and this is ongoing. So I think that announcement of stimulus out of China helped all emerging market assets, and especially that obviously had a knock-on effect on local assets. That coupled with our government of national unity, a lot of momentum behind flows. We see a little bit of offshore flows coming in at long last to the local market. That assisted in us having a fantastic quarter on SA assets. Then if we look at US monetary policy, we touched on that where we said, I think if you look at, they were struggling with high inflation for, a couple of years in the US. Inflation is now a lot better in balance, coming down with, employment. The US is still doing exceptionally well with strong growth across the board. Given the high rates, you're actually quite surprised how resilient that economy has been. What is interesting though is if you look at the market, what the market prices and what the Fed see, you can see the dot plot there on the left-hand side. And at the end of 2025, the average participant see rates just below 3.5%, where as you can see on the right-hand side, the market is saying, you know what, we are seeing cuts actually going slightly below 3%. So there is a bit, the message here, there is a bit of disconnect between the Fed and the market, which means I think on balance, including on the local side, the market has probably gotten ahead of itself. So one's got to be careful not to extrapolate the fantastic performance we've seen the last quarter or two. So I think the market, and I repeat, is getting ahead of itself in terms of rate cuts. But still, we move on to our local assets, and an absolute fantastic quarter. I mean, admittedly, SA bonds and fixed income and generally SA assets were on the cheaper side. With the elections and the government of national unity, that was a catalyst for a big rally in SA assets. You can see there our bond yields rallied about 1.5% in yield terms from what we saw kind of in May and this year. Bonds, as you can see there, all across the curve did exceptionally well. Now, if you take that further and you back calculate the implied country risk premium, we had a fair value of around 4%. It went as high as 4.5 pre-election, and then we had a massive rally. Like I said, a catalyst was kind of more stability, hope for local fiscal consolidation, kind of curbing the debt load of SOEs, better governance, etc. On the back of the China stimulus and the Fed cutting, we saw our local bond or the country risk premium actually coming down to below 3.5% and nearly touching 3%. We believe that given the positive news we had out of the election, that fair value should be now closer to 3.5%, which also means our bond market probably actually did a little bit better than expected. If we move then to being our rate cutting cycle, we had a 25 basis point cut in September as expected. We see another, probably about 1%. The market is looking at maybe another 1.25 as a minimum. So again, I think the market has gotten a little bit ahead of itself. So we see rates probably stabilizing closer to the 7%. But like our governor said, we're not out of the woods yet. We're a small open economy, so any inflation shocks could be an issue. But the last thing I think we see at this point in time and the market is inflation running away. If you look at the predictions, even the SARB has cut back their 2025 inflation expectations from about 4.6% to closer to 4%. And we have seen they're making a lot of noises to make sure we're actually getting an inflation target. They're hell-bent on actually see if they can lower that closer to 4.5% and even probably below 4%. So we'll see how that all pans out. But inflation is not an issue at this point in time. Base effects will take inflation, in the low single digits of about 3%. And then going back up to about 4%. But we don't have an inflation problem at this point in time. I think the other thing which is coupled to, SA Inc. and the good news would be the Rand. We decided to include a slide on the fair value of the Rand. The Rand has been traditionally a bit weaker. Obviously, that's on the back of, I think higher local debt levels, poor service delivery, poor growth prospects, etc. Some of that obviously reversed with the election outcome and, and with flows. And we actually see the rand now gone back to what we perceive as a little bit closer to fair value. We do think flows and positive news and momentum could take the rand a little bit stronger. But around about 17 Rand 50, we're probably closer to fair value. If you think it was just the emerging market momentum that helped the rand do quite well, on the right-hand side, you can see how we did relative to the Mexican peso and the Brazilian real. You can see there the rand outperforming both these emerging market currencies. So a lot of flows coming back to SA. And you got to think of Reg 28 plus people, foreigners disinvesting from local assets. I think that tide, that headwind has now stopped. So, no more Reg 28 outflows. And on balance, you probably see foreigners looking a little bit more balanced and looking at SA. So some of those headwinds might turn into a little bit of tailwinds, which might mean that the rand actually could potentially surprise all of us down the line. But at this point in time, ballpark fairly valued. And now we'll move on to the portfolio overview just to show you what we've done in the positioning. I think for us, the focus is always on diversification, making sure we take capital away from expensive income asset classes and invest in what we believe is cheaper income asset classes. I think bonds have moved, closer to fair value, and you could even argue is on the more expensive side. So we have reduced our local bond duration. Our total fund duration is about 1.3 years, of which 0.7 would be local nominal bonds. 0.3 would be SA inflation-linked bonds, and 0.3 would be offshore bonds. Our portfolio yield is 9.3%, so that's still a fantastic real income yield for income asset investors. So I think on balance, it's a fantastic time to be an income investor. You're still getting good real income yields. And if you look at the portfolio there on the right-hand side, I think core in this portfolio would be our floating rate component of about 38%. Where we can do and try and enhance yield through quite a few avenues. The one thing I will mention, we do think local credit is quite expensive at this point in time. So we need to find other avenues to enhance yield. And there is some select opportunities we've looked at. And then you've got some allocation to SA nominal bonds, and then SA inflation-linked bonds. We added some inflation-linked bonds, at real yields of above 4.5%. Which I think is something that over the medium term should add value to the portfolio. And then lastly, I think some offshore exposure. We've got a currency exposure of only 3.6%, but some exposure to offshore bonds and money market, which is a fantastic diversifier. Having the ability to invest in US Treasuries, and that's also a bit of portfolio insurance should go, things go a little bit more pear-shaped globally, and you've got a big risk-off event. By and large, we've moved the portfolio a little bit more defensively after the third quarter, which saw fantastic performance across the board. And our key focus, stays on having a diversified income portfolio that can deliver the income yields and outperform money market over the medium term. So thank you for listening on this overview, and Anil, back to you.